You have part of the team of the. Okay.
Great, great, great. I want to introduce our good friend, Philip Ammerman, who's the founder and managing director of Navigator Consulting, who's also a mentor here at the Center of Entrepreneurship, a judge at the competition, of the entrepreneurial competition, entrepreneurial in residence, and overall a very good friend and supporter of the center. We can always rely on his good services, and he's going to give us an excellent presentation today. I know the content, that's why I know that it's excellent. And he's going to talk about stuff that really speaks to me, about how far you can go with so little, at least at first, how much far just your energy and enthusiasm can take you before you actually are in real need of funding, and how your efforts in the meantime can actually improve your chances of getting funding in the first place. But I'm gonna let you talk all about that.
Okay, thank you. So everyone should withdraw a safe radius away because I'm taking off the mask. Yeah, so thank you. It's a pleasure to be back here. And what I want to talk about today is how you can get traction without funding. And I know this is a key issue for a lot of startups because a lot of times you need the funding to get to your MVP stage, to improve your prototype, or to get funding to market it. And one of the conflicts that we all face is we have this idea that we're in the startup environment. So it's almost axiomatic that there's a lot of money chasing a few opportunities, and therefore we should wait until the money arrives in order to develop the opportunity. Well, the problem precisely is that exactly because there's so many opportunities and there's so many startups and there's such multiplicity of startup activity in pretty much every segment, traction is one of the main indicators that any investor is going to look at. And if you can show that you're making progress on your own, then your chances of getting funded are going to go up, but also the chance that you actually have the right product and the right product market fit is going to be validated by the activities of the market. So what I want to talk about is just a few techniques and a few things to look at in terms of getting traction and in terms of trying to explain this to investors. And this is a huge segment because we can look at B2B versus B2C startups. We can look at startups, in a large market like the United States versus a tiny market like Cyprus. And, the numbers and the signals that we use to interpret traction is going to be very different startup to startup, country to country, and so on. But if I can just give one request or one recommendation, do everything you can to show development even before the funding arrives, or even before you go into a room to start pitching. It's incredibly important today. And speaking as an angel investor, but also as an advisor to VC firms or to private equity firms, everyone wants to see some results. Everyone is oversaturated with pitches, with ideas. There's no shortage of good ideas or great teams. But one of the 5 most important issues is whether traction is taking place or not. So let's see some of the things we can start looking at. And I think this thing turned off. Any idea? Do you need to advance it because you're on Zoom?
No, but
It's on, yeah.
maybe we don't have batteries. Maybe that's
It's just working.
it was working and it stopped.
Yeah. I said the magic retraction and it stopped.
No,
Okay,
it
great.
does
It
work,
works. It
but
works.
I do suspect it's the battery.
Okay, so it might go off again?
Give me
Okay.
another one.
Okay, all right. So I want to start out with three really well-known figures. And besides the fact that they are old white males, they all have one thing in common. Anyone know what that is? And besides the fact that they're billionaires. They actually all started selling before they had a prototype. And they actually started selling on a shoestring. And when we talk about that culture of, setting up your startup in your garage, two of the three of them literally set up in a garage. It's not a, it's not a legend, basically. I'll just run through it really quickly. So Steve Jobs, who, one of the co-founders of Apple, he started at Reed College in '72, dropped out, was hired by Atari. Remember the old video game maker as a technician, dropped out, traveled through India, came back to Atari, and they asked him, can you create a circuit board for our new game, which was called Breakout? And he had no idea how to develop a circuit board, but his partner, Steve Wozniak, knew how to develop one and knew how to develop them. So they literally bootstrapped themselves, got the components for one circuit board, put it together, and Jobs presented it to Atari. And on the strength of that, they were given a contract to produce circuit boards. Something as as relatively simple as that. And this, they were so enthused by this that the following year they co-founded Apple Computer. Their first three computers were a failure. And they were literally assembling these in a garage. And what really launched the product in '84 was the fact that they copied a graphical user interface as the basis of the operating system, and they copied the idea of a mouse actually from Xerox, from the I believe it was the Advanced Research Facility there. And again, what's inspiring here is that you have people who were so motivated that they simply faked it until they made it, basically. And again, today, of course, you can't really do a computer in your garage, but it's that mentality. Can we at least come up with a prototype? Can we come up with the initial product and go out and try to sell it? Bill Gates was pretty much the same thing. So Gates enrolled at Harvard. He dropped out before graduating, and he literally cold called the equivalent of a giant computer company back in 1975 to develop an emulator, to develop essentially the software for the Altair 880 microcomputer. And he convinced this company to buy it on the basis of an interview. So he had no software, he had no product, he had no idea how to really develop this, although he was an avid programmer. And working together with his partner, they developed this emulator in '75. This led to a contract to develop the same type of emulator for BASIC, for what became the IBM PC. They literally licensed someone else's operating system. It was called the 86-DOS, and they called that the PC-DOS. And IBM gave them $50,000, and that was the beginning of Microsoft. A $50,000 contract for a software package that they didn't actually have before they went out and sold it. Now, am I recommending you do the same thing today? No, or if you do it very, very carefully. But it is possible to actually sell without having the perfect product. And many times, we say that the perfect is the enemy of the good. And this is one of my problems. I like things really to be perfect if I'm going to launch them. But a lot of times what you want to do is, in fact, avoid the perfect, go to market fast, figure out how the market responds to what you're doing, and then keep on pivoting, keep on improving the product, keep on releasing new features, and so on and so forth. So what we're all worried about tends to be this valley of death, right? It's this area where we have agreed to do a startup. We maybe don't have an MVP, or we're working on the MVP. We're burning through cash. We have no income. And this is obviously, a totally paranoid situation. And I think we've all been there in our professional journey. The question is, what can we do to start generating income, or if not income, at least generating traction, so that by the time we get off of our seed funding and go to our first real funding round, or Series A round, we can show some results and we can show some progress, which can be measured in tangible indicators. And The other thing which looms large is that there's this huge business failure rate. So, our challenge is to reverse the cash flow or the free cash flow loss and try to reverse that and go up into profitability. But the fact is that something like 90% of startups, or at least new companies, are going to fail, within the first 10 years. And in fact, within the first 5 years, at least in the United States, roughly 50% of them fail. And by the first 9 years, something like, a far greater number wind up failing. So, yeah, we have this idea of failure. We have the idea that we're going to need funding to reverse the failure. And the question is, what else can we do to keep going? So what is traction? Traction is an interesting word, and it simply means the progress and momentum of a startup company. And how you define that is up to you, right? So you can define that as being, say, the number of app downloads, the number of people in your mailing list. It could be the number of freemium accounts you have, and so on and so forth. But the good thing is that the initiative is up to us. It's up to you, and it's your startup. So you control things like pricing, you control things like publicity, you control things like, the freemium accounts or the free accounts you want to set up, and so on and so forth. And I really encourage you to use that to the maximum, because once you get investors on board, your flexibility is going to decrease dramatically. Right? If you do your Series A, that means you're committing to monthly board meetings, quarterly, accounts and reporting. It means you're going to be pushed towards, meeting all of the objectives in your business plan, and that's being done in order to show financial results. So you can either list, or you can go to Series B, or you can sell out to someone else. Gabriel Weinberg is an author who's written a book about traction. He says almost every failed startup has a product. What failed startups don't have are enough customers. And this is really the case. So, it's the customers who are going to pay us. That money is the oxygen of our company, the lifeblood of the company. And that cash flow is what's going to determine if we succeed or fail, actually, over time. An example of traction is, any kind of indicator that you can point to and you can verify, which shows very good results. Now, what we've got on this slide is we have the app downloads of Weebly. New account registrations on Weebly. Weebly is a website developer like Wix.com or WordPress. It came out in 2008, and as you can see here, in the first few months that it was live, there was very low traction. There was a very low number of installations. The company was then profiled on Wired, so there was a spike, right? And then it went down again, and then gradually traction took off. And what we see here is we're basically measuring the number of new accounts being created every day. And what's important about this curve here is that it's literally, a very classic 45-degree angle curve that shows that we're really making very, very good progress over time. Now, this sector is, it's not exactly clear if this is a B2B sector or B2C sector. It's probably something in between. If you look at LinkedIn and you look at, some of their traction indicators, LinkedIn was generating something like hundreds of thousands of new accounts every day when it was taking off. Okay, so what we measure here and the axis that we measure it on, that's up to us. We have to define that. But what you do want to show is you want to show, substantial progress over time if you can. And again, this is where we start running into problems, because if you're in Cyprus, right, we have a population of about, 870,000 officially, probably about 1 million unofficially, if we count tourists and residents and everyone else. So your vertical axis here is going to be very, very limited. So companies always tell me, yeah, we're going to start in Cyprus and it's a great sandbox, it's a great place to prototype and to test. And I agree with that totally. But the problem is going to come with the next step, because the next step you're going to try to expand to another market, you're going to probably need funding for that. And if you go to a VC and, if this thing is measured in like 50 unit increments, they're going to say, well, okay, you're going to have to convince them that that 50 unit increment can become 1,000 or 2,000 or 5,000 units per day. And the same thing happens with the lessons we learn, because Cyprus is a very, very particular market. It's a market driven by social capital and a market which is heavily fragmented. So there's really oversupply in every sector, right? If you look at the number of kiosks or the number of cafes in Cyprus, you know there are probably more cafes than there are stray cats or something like that. There are probably more startup conferences than there are actual startups in Cyprus. But the point is that the lessons you're going to learn here are going to be very heavily restricted to this market. And then when it comes time to change that, it can be very, very different. And that's why I really, you know, when you're defining traction and you're defining which market you're going to launch in, one of our first questions as a small fund of angel investors is, you know, are you in the right market? Should you be testing this here, or should you be testing it, say, in London or New York or I don't know, somewhere else? So just take into account that if you want to show traction, make sure that that traction is aggressive and substantial, and make sure that the means with which you measure it translates into a larger market, which is going to be, you know, it's going to make sense to one of the bigger investors or VCs that you might be pitching to. One of the tragic mistakes that we made when we launched our first startup in late 2009 is we launched a peer-to-peer business intelligence network online, and we were getting like 20 to 30 registrations per day, and we were very happy because this is a B2B sector. We didn't have a lot of money for promotion, whatever, and you know, I was talking with some VCs in Silicon Valley, and I said, you know, they said, so what's the sign-up rate of new customers? I'm like, yeah, well, 40 to 50 per day. Like, you know, what? Okay, you know, talk to you next year, or don't call us, we'll call you, basically. So just really, really take into account the market you're in and how you define this. Different companies in this space have traction indicators which essentially express their business model. So if we look at Airbnb, the metric that represents value for them is the number of bookings they have, typically per day or per night, and then the number of stays, in other words, the number of nights per booking. And the frequency for them, ideally, is measured annually. Why? Because when you have a whole year, you know that you're going to have some spikes in demand, like maybe at Christmas, maybe for summer vacations, maybe something like that. So when Airbnb is out there trying to show their valuation, you know, they're looking at annual stays or annual bookings and the increase year on year. Facebook is looking at not just the total number of users. So as you know, I think Facebook has something like nearly 3 billion accounts right now, but they're looking at the number of daily active users. And why? Because it's only if that engagement is daily that you can try to predict the advertising income you're going to get to a little bit a better degree. And Facebook's whole valuation is the advertising income, right? That's what drives their business model. So again, you can choose a traction which reflects your business model, like, you know, very, very clearly. But chances are, if you're again at the pre-launch mode or you're at the startup or the launch mode, probably might not have a lot of money. You might not have the funds necessary to go out there and promote aggressively, and therefore, you know, to show a very high takeoff. And one of the things that we spend a lot of time working on is how the traction expresses the sales funnel, or your process of converting visitors into customers, and those customers can be expressed as either free users, so in a freemium model, or actually paying customers. So there's a lot of effort that goes into understanding, you know, what's your business model, what are the indicators that need to be used, and how can you make this process more efficient. At the top of the funnel, we have our total available market plus our service available market, right? So the total available market is the total number of potential users that you've got that you're targeting for your startup or your service. The service obtainable market is how many of those, the service available market, SAM, is how many of those you think are well suited to conversion. And your obtainable market is how many you think you could convert over a period of time. So what we're doing here is we're using online marketing to identify those potential consumers or customers to get into your sales channel. And that sales channel may be your website, your YouTube site, your Facebook page, but it could also be in-person selling, right? It could be your email list, it could be your advertising budget or whatever else. So we need to think in terms of all of the channels we have available to get people onto that sales terrain where you're going to start converting. So we've got online marketing, we have online sales, which is the process of converting visitors to customers. And so if someone is going to look at your website, ask yourself the question, what are you doing on every page of that site to convert someone from a visitor into a customer, from a passive viewer into a potential traction indicator? That might not be sales, right? It could be email signups. It could be people who are downloading a white paper. It could be people who like you on Facebook as a result of visiting your webpage or something like that. Okay, so even if you're not selling, and even if you're not in a sector where you can successfully transact online, at least figure out how you can get traction online and convert people, converting them from viewers to customers. And then outside the sales funnel, we're looking at customer care and after sales service. And again, there are a lot of indicators here, which are just, the defining indicators of the startup that any VC or angel is going to ask you about. So let's look at some of these. If we look at some generic online marketing indicators, we're looking at things like website traffic and the traffic by source. Something like 50% of all startup funding today is spent on marketing, right? So someone closes a 20 million round, roughly 10 million of that is going to be on marketing. And it's precisely to get people to come into the funnel. And so if you're pre-funding, we want to look at, how well you're doing with organic results, but also if you have put a trial budget on advertising, what's your click-through rate and what's your conversion rate? Okay, so like what's the cost per click? How many people are going to click through based on the number of impressions or whatever the advertising format is? And then of the number of people who actually get to the website, how many convert into customers? So again, if you want to convince someone that, look, I want 1 million euro to grow my company, the easiest thing you can do is set up a landing page and a conversion funnel. And if you can't sell, at least get some other form of conversion. Get early signups, get newsletter signups, offer something to customers that they can actually access as you behind the scenes work to getting funding and, to actually getting resources to grow. You can look at things like traffic from emails or social media. Yeah, please. Yes.
So sign up very important. So how much sign up you have to achieve to raise capital?
It is tremendously variable. It varies if it's business to business or business to consumer. Typically, if you're in the B2C sector and if you're trying to raise money in some place like, I'm going to generalize now, okay, but London or Paris or Frankfurt, you probably want to look at least 100,000 people who've signed up for something or who've interacted with you in some way. There's a lot of startup funding available in Athens. And in Athens, you can remove 1 0. So, from say 80 to 100,000 in your list, you can probably come down to 8 to 10,000. And again, that's because, the guys in Athens are very, very clever. They've seen this process before. They've been working in the startup field for already 10, 15 years now. And they've had the experience of taking something suited to the Greek or Cypriot reality and then pushing it globally and actually onward, either getting a second funding round or selling it onward to someone like Daimler or Microsoft or someone like that. So just keep these numbers in mind. I think if you're in the United States, we're probably looking at 500 to 1 million. If we're looking at London and we're pre-seed, I think we need at least 100,000, and that's Northern Europe as a whole. But again, it's so different sector to sector that it may not be the best indicator. Yep. Again, let's say that you're selling banking software. You don't need a lot of banks to prove that you've got, you have traction. So if you've got like 400, if you've done like a lead campaign and 400 banks or fintech companies say, yes, I'm interested, that's nice. We see that as a potential gold mine. We then like to see of the 400, how many calls and presentations you need to do in order to convert one, right? So it's very different. Like you take the tourist sector, hotel, the hotel area is ripe for disruption in terms of software sales, artificial intelligence, analytics, virtual reality. There's like thousands. I mean, there's huge innovation potential that you could do in that sector. But you know that there are millions of hotels, right? So within that hotel sector, you want to narrow it down. Are you hitting 5-star hotels, 4-star hotels? Are you hitting like villas or bed and breakfasts, right? It's just so different that, it's heavily sectoral dependent. But just keep in mind, again, we want to look at that difference between your organic traffic, your organic and your sponsored traffic. And if you've got any kind of conversion rate, make sure you're showing how people convert. It's really, really important. We want to look at things like traffic by keywords, number of visitors, repeat visitors, bounce rates. All of these are classic web analytics, and it's the easiest place to start for conversion. And it's something that you may only have 1 or 2 of these indicators, but when you do your pitch, you're going to base it around like maybe 3 to 4 traction indicators. But when the due diligence process starts, the people who you are pitching to are going to want access to your Google Analytics or to whatever, other analytics platform you're using. And especially they're going to want to look at things like real-time analytics. How many people are actually on the site right now? How many daily active users are there? How many come back? And how often? And so on and so forth. So these are just some very generic indicators above the funnel. Once you enter the funnel, we're looking at things like, app. If you have an app, it's the app downloads, then the activation of the app, and then the number of people who are actually using the app, daily, weekly, monthly active users, paid versus free users, and so on and so forth. We're looking at number of customer accounts created, and this is key. And you don't need to show necessarily that the customers are actually active. You can show a high customer account creation rate and a growth rate. You're on the right track. Things like, the conversion rate, obviously, that's number of visitors who purchase versus total visitors. You want to look at things like dropout analysis, or the number of people who, they might buy once, but they don't buy a second time, or they sign up 1 year and they don't renew, so on and so forth. And just, quite a few other indicators here. And again, it's going to be very dependent on your sector and what it is that you're actually selling. And then finally, we're going to look at customer care. So what happens in terms of things like the renewal rate, technical support requests, traffic to technical support pages, the number of inquiries, and so on and so forth. Now, why am I showing this? I don't think this is new to anyone, but I think what's very important is that when you develop your business plan, this is part of your business plan. So you're not going to show, you don't want to show just like revenue, right? Or like number of installations, average cost per installation, and therefore the revenue. You're going to want to show your defect rate every year and your renewal rate every second year. Okay, and you're going to want to show that you're taking steps to understand how customers are interacting with your product, how the product market fit is working, and therefore what indicators a VC or an angel can look at over time in order to understand, yes, we're going in the right direction, or no, we're not going in the right direction. So think about this not just in terms of what you're seeing now, but when you forecast it forward into the future, right, for your business plan, which is going to give you your pre-money valuation, your post-money valuation. It's going to inform you when the next seed round, when the next series round is going to be. All of this stuff should be documented. And the great thing, again, online, is we can start playing with this immediately. All right. So I mean, there's a lot of tricks you can use, or a lot of methods you can use to start, understanding what's going on now. So, for instance, you can take €100 or €500 or €1,000. You can start running ad campaigns and testing what the conversion rate is. Once you do that, then you have a basis to say, look, I ran an ad campaign in Cyprus for a month. These are the results. Therefore, I'm taking these results and forecasting forward my target markets, and this is the amount of money I need in order to get this result. There are a lot of customer metrics. These are some of them. I don't want to get into a lot of details here. You can find a lot of this stuff online as well. just one thing to take into account is that we see the bounce rate as really increasing. And this is a function, I think, both of the amount of money spent on advertising and social media, as well as the general saturation in the sector. So one of your problems is you may have a bounce rate now. And the question that someone is going to ask you is, okay, let's say I give you 10,000 euro and your cost per click is like, I don't know, 10 cents. So sorry, 1,000 euro is going to give you, say, 10,000 visitors. If the bounce rate is 50%, are you running the conversions with the bounce rate, or are you removing those bounces, right, and running the conversion without it? Normally, you should run it without it. And why is there such a high bounce rate? Again, we are saturated in every sector. So when I started my company in 1995, we were the only navigator consulting out there. Today, if you do a search for navigator consulting, there's probably 20 or 30 quickly visible online. So there's just, again, choose your brand name carefully, choose your domain name very, very carefully. And there's still time to change if you see that you're getting a high bounce rate because of your name. Again, our first startup was ECN, European Consulting Network. And ECN is also the name of a financial, like a trader network. And so we have a high bounce rate because people are, for whatever reason, there's an overlap in some of the content we have. So they come to our website thinking that they're going to see, trading information, and in fact, they get consulting information. So it's, this is just one of these many things that you really have to be careful of, but at least you can experiment with it before you launch and before you really go for funding. So how to think about traction? Well, first of all, you've got to work strategically. You've got to understand what indicators you're looking at, how often you're going to measure them, and who's going to be responsible for measuring them. I mean, where you get the data from. So I would literally write down the goals that you are looking for. And again, these goals in any case should be part of your operating and financial model that you're going to use, on the one hand to raise funding, and on the other hand to monitor your progress as you move forward. So you're typically looking at things like, again, app downloads, user registrations, website traffic, conversions. Maybe if you're in the B2B sector, maybe the number of cold calls you have to make, or presentations you have to make, so on and so forth. And again, I encourage you to do this in reality by starting the conversion process, even without an MVP. The second point is you want to drill down as far as you can into the weeds so that you understand what the reality is of a specific market. So I'm advising, for instance, right now I'm a mentor for SAP, for the software company. SAP is investing in startups and supporting startups, and they've just launched a startup factory in Armenia, and I'm one of the mentors there. And we have a brilliant startup in Lebanon, in Beirut, which is doing event scheduling software. And they have defined their target market as being Beirut, Egypt, maybe Dubai, maybe another Middle Eastern market. And this is certainly interesting. But one of the fundamental questions I'm asking is, okay, if you have 100,000 euro to spend in investing in Dubai, and you have 100,000 euro to spend in investing in London, where are you going to get the greatest return? Where are you going to get the greatest take-up? And that's where you need to understand strategically how important is your market. So a lot of startups here see Greece as being a great market. It's 10 times larger. There's a lot more capital available. There's lots of VC firms there, and so on and so forth. But if it's going to take you, say, 18 to 20 months to develop the Greek market, because the Greek market is horribly difficult to enter. There's lots of bureaucracy. There's lots of regulations. And if you think how far your competitors are going to be moving, maybe that's not the best market to enter, right? Or a lot of people say, well, okay, I want to enter the Russian market, and Russia's a fantastic country, but they have the ruble, right? There's high inflation. If you're selling and if your costs are in a euro denominated, market, your product is going to be a lot more expensive. Maybe rather than Russia, you should look at something like, I don't know, Sweden or France or something else. So figure out what your strategic market is going to be. And again, you've got to figure this out in terms of where you can demonstrate traction and therefore attract capital. So and forgive me for saying this is probably going to sound terrible, but the euro that you earn in Cyprus is not the same value as the euro that you earn in the United States or in the United Kingdom, okay, or Germany or whatever. And I don't like saying this, but I see it every day in my work. So if you've got the chance to enter one of the more competitive, larger markets, by all means do that. Go for it. Grab the opportunity. Well, if you have to take a year off college and go there and work and develop and, live in horrible conditions and eat, kebabs every night because you can't afford a regular meal, do it. Because if at the end of that year you can say, look, I've generated, say, 70,000 new accounts, that's saying something. And if you say I've generated 70,000 accounts in Cyprus and you say that to some of these VCs, they have no idea where Cyprus is on the map or what that means. Okay? So differentiate the markets, but also the clients. And this is something that, again, it can be very difficult to do. So for example, if you're in the fintech sector and you're trying to sell something to a bank, it's very difficult to convert a bank, right? They have legacy software systems, they have regulatory issues, they have security, they have, the full range of problems. It's a great customer, but it's the most difficult customer that you might need to convert. And it might take you 18 to 24 months to convert it. If you've got other customers, like say Forex firms, and it only takes you 4 months to convert the Forex firm, go for the Forex firm, right? Because you can still show a large number of accounts, a large number of trading activity, right? Some real numbers in terms of either assets under management or transactions or stuff like that. And that's things you can use then to justify your valuation and your product market fit and everything else. The second thing is to identify who a reference client is going to be. And a reference client is someone who is the client, which is like the ideal client for your startup. So for instance, let's say that you're doing software for automotive fleets, okay? And you have a chance, yeah, my aunt runs Amathus Car Rental and they have 12 cars that they rent to tourists. Or I can go to Avis or Hertz or, Sixt and I can try to convert them. Well, yeah, your aunt, you're probably going to convert her immediately. That's fine. But the reference client is the global brand name. Because if you walk into a conference room and you say, Avis and Hertz and Sixt are my clients, that means something, right? It's got a weight, which, the first one doesn't necessarily have. And the third point is figure out how you can gain scale in a segment. And that means rapidly grow in a niche or an identifiable segment. So, Facebook, I don't know if you remember this. I'm old enough to remember it. But Facebook started in universities. And if you were not in an American university, you could not set up a Facebook account. For that? You probably, I remember it. And so it's only after they got scale in universities that they opened up to the United States. And then it's only once they got North America that they expanded into Europe and then they just exploded globally. And there's a reason for that, right? Because it's a market they know. It's a small market. It's a small community. And, there's a big social benefit by knowing who your classmates are, who your professors are, who the alumni are. It's like a no-brainer. You're going to want to do that. And what did we have before Facebook? Does anyone remember? Even not tech. What did people use before Facebook? Yearbooks, remember? Did you have to get your photo taken for the yearbook? And it was a horrible process. I hated my yearbooks, but that's what people used before Facebook. Airbnb started because the founders could not afford a hotel room during a trade fair, I believe in San Francisco. PayPal started doing a single thing. It was the payment processor for eBay. And then it was bought by eBay and then it expanded. So identify the segment. How can you scale up quickly in the segment and get those reference values? And think in terms of friction. Where is there the less friction? Where is it easiest to convert customers or even apparent customers? A customer doesn't have to pay. You can have free customers. Give them the app for free. If it's a reference value, it's going to help you sell to others, and if it's going to help you understand what they're actually looking for. Another really powerful tool is pricing. And I think that pretty much everyone needs a freemium model. That means free use of the application for limited functionality and then full use versus a subscription. But if you're in the startup mode, there's nothing wrong with giving free services to reference clients, as long as it doesn't tie you up in knots with, service requests and customization and things like that. And you can also consider free use for specific segments. So again, let's say you are selling software to a government. You know how difficult it is to go through a government procurement process, right? There has to be a tender, pre-qualification, a short list. You might need to put in a bid bond. You've got a bid, and so on and so forth. Well, imagine if you say, right, I'm going to give it for free to a small number of public organizations or to some embassies or something. So at least I can show that I have the installations and I have the technical requirements. It's not going to reduce the friction on the procurement cycle, but at least it's going to consolidate my standing in the market. So pricing is really important. And again, pricing typically takes place when we're at our most desperate, because we tend to think about prices once we've launched, and when we've launched, we need revenue. So like every customer becomes valuable, and we tend to be hesitant about giving away free accounts. Does anyone remember AOL, America Online? Remember they were giving away free DVDs, free CD-ROMs with the, right? It was free. They were giving it away for free. People were testing the service, and then people were converting because they liked the dial-up service. So think in terms of the price really carefully. Okay, publicity, I think, is probably self-evident. I'm not going to spend a lot of time here. I just want to show a couple of things. So we typically tend to think about, being featured in specialist press or things like blogging or stuff like that. There are so many examples of startups that have taken off because of the mainstream press. So if you have the chance, to be profiled on Oprah, or if you have the chance to go onto TV or, do some interviews or something like that, and this mainstream press corresponds to the audience that you're trying to reach, by all means try to do that. And guys, for me, this is where Cyprus is the #1 destination, because you can reach any journalist you want in Cyprus. And if there are no political issues with what you're selling, there's no party affiliation, it's very easy to get free publicity, even on TV, right? You're all young, you're all innovators, you're all talented, you're all, you're the future of this country. So people want to hear a good story. People want to interview you. And, newspapers and channels all over the world, they want content, and they want something positive, not just the horrible news that we read every day. So as counterintuitive as it can sound, this is still very, very important, depending again on the sector you're in and what you're going for. Some startups have really worked successfully with evangelists, ambassadors, reference marketers, others with peer-to-peer marketers. I just want to give a couple of examples. Again, there are thousands of examples here, and I don't want to go through all of them, but one of the most successful and low impact methods right now is the so-called product unpackaging. You've probably seen that on any number of YouTube videos or TikTok videos or whatever. Someone gets a new computer or a new iPhone and they open the pack and they do a video of how that pack opens. So if you're selling a physical product, pay a lot of attention to the packaging and to the customer impact of the packaging. And it's very, very easy to create content like this. Right. So this is an early example of Revolut, and I think Revolut is one of the most successful fintech launches. They literally got 1.5 million accounts in like very, very little time, simply on the strength of the product and the software. Okay, the packaging, of course, was important, but that whole sign up and that whole verification process totally revolutionized how we think about applying for credit cards or debit cards in this case. Another clever idea, of course, is the referral. That even right now, they're still offering something like €50 per new account created. For a startup, that's obviously a lot of money. It's a big liability. It's a big danger. You don't have to do something like that. But if you've got a freemium model, then you can trade off the subscription that you would pay for a referral. You can say something like, refer a customer and then get free use of our app or something like that. Revenue itself, if your MVP isn't automated and launched, figure out if you can still develop income from the process that you're using without the app or without the software. And I know this sounds a little bit strange, but you know, there are global companies today that have serious problems that they cannot solve. You may have a great software solution for it, but you don't have the money to develop the software solution for it. At least can you make the first steps, maybe through some type of a consulting approach? Can you enter one of these open innovation competitions? You know, can you somehow engage the stakeholders, whether they're B2B or B2C, and try to gain some income from there? And I know this is heretical because we're all thinking about the actual software, we're all thinking about the platform or the app or whatever, but it's amazing how much income you can actually pick up simply solving the problem without the app. So think about that. Now, if you're struggling to get to the MVP, a lot of companies have had a lot of success selling subscriptions. And I'll show you a couple of funny examples in a bit, or developing something like a pre-launch mailing list. So if you think about crowdfunding, have you seen platforms like Kickstarter? Okay. 1 out of every 2 offers that you see there will actually give free access to the product once the funding has been gathered, right? So if you think about that, that gives a double incentive to the backer. The backer knows that, yeah, I can pay 100 euro or 200 euro, 1,000 euro, whatever, and I'll feel good because I'm supporting a startup. But at the same time, if the value of the product is worth that, then they actually get the free product, right? And so they become an early adopter. So think about, you know, how you can maybe set up a system like that to maybe get some early monetizations and valorizations. And this probably sounds crazy, except that Tesla has pioneered this, not just with like millions euro of income, but billions of euro of income. When Elon Musk started selling Teslas, he didn't have a car in a parking lot, right? He started taking down payments for cars which were going to be delivered 24 months in the future. And basically people didn't even necessarily know what color it would be or what the full functionality would be, right? And so like the Model 3 topped the first year sales projections in the first 24 hours. The other examples, you've probably seen this, you know, there are startups where they start offering you an early peak or, you know, a first viewing or, you know, beta testing or stuff like that, you know, or use an exclusive code, get, you know, your early bird special or stuff like that. People do respond to this. And again, this is somewhere where if you're in Cyprus and you're in a B2C focused sector, this can be very, very successful, precisely because Cyprus is a small market and social capital is very important. So word of mouth marketing is very high, and chances are, you know, if I've applied to a Revolut card, I'm going to boast about it. I'm going to ask my friends, have you applied for a card? You know, let me help you, or this is where you should go, or look this up, or whatever. But again, this is an area where launching in Cyprus can be a big, big advantage, because you can just mobilize the social capital and mobilize the social network that you have around your family, your friends, your employer, your university, and other networks like that. Open innovation. I don't know if you've come across this, but this has been a very heavy trend in the last 10 years. There are major strategic accounts that realize that they need to attract talent. They need to attract a fresh viewpoint to solve very old problems. So chances are, if you're like in the banking or the fintech sector, there's always open innovation offers by some of the major banks in the world. One of my favorite ones right now is actually Arab Bank. I don't know if you've heard of them, but it's a major bank in the EMA region, mainly Middle East and Africa. And they have an accelerator which offers you 500,000 euro and hosting in one of the banks. And if you do something which the bank needs, they're going to adopt it. So you often have open innovation together with business accelerators or, you know, calls like this. And again, depending on what sector you're in, some of these can be really, really compelling and really, really interesting. It does mean, though, that you're going to have to pick up, leave your comfortable existence here, and probably move somewhere for 6 months or 12 months while you work on a problem. You streamline the problem, you know, you streamline the solution, and you use the network of that organization to actually create the MVP and then sell the MVP. But it's pretty much, I find this very interesting because, you're going to be working with some of the top names in the sector. And then once you have your MVP, they're going to support you one way or another. They may invest in you, they may come on as a board member, but you can also say, this is what we did, this is what we accomplished, and this is the organization that we accomplished it for. And it might not be your MVP as you see it now, but it will be something equivalent. It will be several steps up the ladder. And finally, you can do something outrageous. And again, we're in an oversaturated environment. How many of you have ever bought a flamethrower? So Elon Musk pre-sold 10,000 flamethrowers for a company called the Boring Company, where he didn't have a single piece of equipment ready for it, right? Boring Company, they build underground tunnels. He had no engineering experience of this kind. He had no prototype, he had no MVP. There was no certification, there was nothing. He had the idea. And he launched the company as a company. And to gain attention for it, he bought 10,000 flamethrowers and sold them at $500 each. And he raised $10 million in a week. You can do that in the States. Here, it's a little bit more difficult. But at the end of the day, if nothing else works, do something outrageous. Think outside the box. Take a hot air balloon across the Green Line, or something like that. Do something it's going to get your name established in a market where people might be a lot more risk averse. I mean, if you looked at Musk 10 years ago, his one success was PayPal. He was one of the two co-founders of one of the two companies that eventually merged on PayPal. And since then, he started Tesla, he started the Boring Company, and started SpaceX. And he has quite a few other startups that he's involved with. And he does it just like, you remember Richard Branson 20 years earlier. He's done that by, on the one hand, the force of his personality and his ideas, but also his ability to capture people's imagination and to actually do stuff which could probably not be conceived of earlier on. So think of growth and traction. Not all traction is finance related. A lot of it is actually non-financially related. It's consumer activity. There are ways to grow without capital. You need to be careful on how you tap these and how you prioritize them. But the more traction you demonstrate, the higher your valuation is going to be. Today, it's pretty much a condition for showing that you have, you need an MVP or a prototype. You need to show how the product market fit works. And the more traction you get, the better your product is going to become if you pay attention to customers. If you keep improving, you keep releasing new features, you pivot when it's needed. So my advice is sell now. Don't wait for a perfect product. Do whatever you can to start selling. And if you cannot sell, do whatever you can to grow in non-financial methods to really establish, who you are, what you're doing, why it's valuable. And if you're lucky enough and if you're consistent enough, you will succeed. We are in an environment where there is too much capital chasing too few ideas, where there are so many things that need to be changed as a result of the internet and as a result of the disruption that this causes, that I think there is just no limit to what we can do as innovators and as disruptors. And again, if you look at some sectors, you take the banking sector, right? We all would have thought, okay, we had e-banking, so the banks were great. Then along come all these great fintech companies, and they've totally revolutionized how we think about everything from credit cards to payment networks to savings and saving education and so on and so forth. Same thing exists in tourism. Cyprus is a tourist country. 20 to 25% of our GDP is tourism. The rate of innovation in tourism is practically zero. We think about software, right? I mean, yeah, we have Airbnb, we have Booking.com, and that's fine. But what does the average tourist enterprise do to improve its productivity, to improve its analytics, to improve its decision-making? Practically zero, basically. So we have huge opportunities there. We have huge opportunities in food and beverage. We have huge opportunities in public sector management where, and I don't know if any of you have been in a Cypriot ministry before or a Greek ministry. You know, they're working, they have software terminals, but the fundamental value chain is pretty much exactly what it was 40 years ago. So the more we advance in this, this brave new world that we're in, the more opportunities come about. Follow that approach consistently, and you really focus on the quality of the product and on the solutions that you can provide. Chances are you're going to be backed. Might not be backed in Cyprus, but if you show up and you've got the right preparation, have the right traction, I can put you in touch with investors in Athens or London who are looking for opportunities and who will give everyone, a fair hearing. Just need to be ready. So that's just a few things I wanted to share, and I'm happy to answer any questions. If you have any questions after the seminar, you can reach me here. I think the slides are going to be distributed as well.
Yeah.
So if I can help you in any way, please feel free to reach out. And a lot of you are in the entrepreneurship competition, so I'm sure we'll be seeing more of each other. Yeah, however I can help, I'm really, really happy to do so. So any questions? Yeah.
Yes. One question about investors and methodology. What's the key things that we have when we feel? I know some friends of mine at some point they didn't even have control of the company.
Yeah.
And for me that was work, for them it was.
Yeah.
So
yeah. This is a huge area. This is a huge discussion. But I'm going to start at the end and warn you about the end, and then maybe we can look at some of the things at the beginning. So the end is the term sheet. And the term sheet is the list of conditions that you're going to negotiate with an investor, whether it's an angel or a VC or private equity or whoever. It's not the contract. It's the list of conditions. It's a term sheet. And a lot of these are very, very complicated. Some of them can number thousands of pages. And the language is very, very specific. And if you don't have experience with this, you're probably going to get burned, or the risk increases that you're going to have problems. But you need to look at things like, is there a difference between an ordinary share and a controlling share? An ordinary share is typically just any share that can be traded, but a controlling share is one which gives the bearer or the owner of that share decision-making or greater decision-making power. So for example, if you take Facebook, Facebook is controlled by one person, Mark Zuckerberg, because he has the decision-making shares in the company, even though investors have the financial equity, a greater share of financial equity in the company. So always look at that share structure. You always want to look at the governance structure, and typically angels are different because we're like seed funding, and typically we believe in the team, and we're backing the team because it's just a risk that we're willing to take. But VCs have a structure. They have money which is sometimes raised from pension funds or other public sources, and they're responsible, and they have a fiduciary responsibility for that. So in governance, they might say, we want to appoint the chief financial officer. We want to have, say, maybe three of the founders will be on the board. Maybe 3 people from the investment side, the investors will be on the board, and then maybe another 2 non-executive, independent directors. And you want to be very careful of how these people are elected and appointed, and under what conditions you can remove them. Turns out that they're not working in your best interest. Under governance as well, it's how decisions are going to be made. So typically there are going to be clauses like, any investment over 10,000 euro has to be approved by, not the CEO, but maybe by the board of directors or something like that. You are going to want to be very careful how equity raises work, because, let's say that you close your angel round and you're valued at €1 million now, and then you go for a Series A funding and you're looking for €10 million. you haven't raised the valuation from 1 million up to 10 million or more, you're going to lose, right? You're going to be diluted, basically. And the further you're diluted, that means the less control you have over your company. That's why A and B shares or ordinary and preferred shares can work to the advantage of the founder team. Another thing, which is very, very negative, is that a lot of times staff are promised stock options, and when a capital raise occurs, they get diluted. Why? Not because it's not planned that they're going to get diluted, but someone like say SoftBank might come along and said, okay, I'm going to give you 100 million. And that is just so attractive that you're going to take that offer because it's going to catapult you to another dimension. But when you look at the pre and the post money valuations, you realize someone is going to just be flattened, basically. So be careful of the size, and if you can, maybe agree to a release schedule based on achievements and based on a corresponding higher valuation. So if someone like SoftBank comes along and says, I'm going to give you 100 million, and if your pre-money valuation is $1 million, well, you're wiped out. You have no equity left. You have 1% in the firm. So rather than say, okay, I want you to commit to $1 million, but I want maybe 5 million this year, or maybe 5 million next year, and make sure that in the intervals, the value of your company is going up sufficiently to safeguard your own valuation. Vesting schedules are very important. The vesting schedule says when you can actually sell or exit the shares that you have, valorize them. And typically, the standard condition is 4 or 5 years. So that means that your stock options might suddenly be worth a lot of money, but you cannot actually use them for anything. And if you don't have other revenue, you're getting squeezed. And so you always want to make sure that you've got, you have some type of financial latitude that you can use the shares, even if you can't sell them. At least maybe you can use them as collateral for a private loan or something like that. This is what happens at the end, the term sheet. And it's typically full of minefields, and you typically need a really good lawyer to guide you through the process, and you need to confirm that with another investor or VC or someone who's on your side, who's going to be defending you, pointing out the pitfalls. Before that and after that, there's any number of risks. Most VCs are very aggressive, so you want to make sure that on the one hand, you want someone aggressive backing you up and pushing you to perform, but you don't want that if it's going to cause problems with your actual product and your actual customers. And what a lot of, the reasons that a lot of founders drop out is because they merge with someone or they're bought by someone and they simply don't like what happens. So I think the most popular example of that is probably Instagram. You recall that when Facebook bought Instagram, Facebook promised a lot of stuff. They didn't really deliver. The two founders walked, leaving $6 billion on the table. That was like 2 or 3 years ago. Today, those $6 billion are probably worth, 40 or 50 billion. The way the stock market has risen. So it's a very complex. I could talk for days about this, but I don't know that we have days. Just be careful who you're investing with. People invest from a wide number of reasons. Some of them invest because of fear of missing out, FOMO. Some of them invest because they see it as self-validation. Some of them, especially family members, cannot draw the line between the financial support and then, oh, you're doing this wrong, you should do this, you should do something else, and you risk ruining the family relationship that you have. So in general, just try to pick the investor who's closest to you in terms of things like ethics, culture, their priorities, and just make sure that if you're not sure about something, don't sign anything. Get a reasonable explanation for it, and if necessary, document it according to minutes of the meeting or a side letter or something like that, because Murphy's Law is whatever can go wrong will go wrong, and a lot of stuff goes wrong in this space. Also, you've got to be aware that a lot of VCs are actually in a hurry to exit. So they're not coming with you to be with you all the way to an IPO. They're only coming with you until the next round, and maybe they can either exit partially at that round, or at least you know, the 1 million that they invest with you in Series A suddenly is transformed into 10 million in Series B, and they can use that for whatever other reasons they have. One thing which is very important, make sure that they're not backing other competitors. This also happens all the time. So the bigger the VC, the more exposure they tend to have in a sector, and then sometimes they will have invested somewhere else, and that becomes a priority, and you're either ordered to merge with them or they leave. Just leave you know, kind of hanging. One of the, we had a fintech client that we were advising. We were not investing, just advising. And it was a digital challenger bank, which was going to set up in Germany. Really, really good team, really good ideas. We took them to a private equity firm in London who we knew was already buying banks. So the problem with setting up a bank is getting the license. It takes 2 years in the best case to get a banking license. You have to go through a national approval process, and that's typically a year if you're lucky. Then you have to submit to the European Central Bank, and if you're lucky, they're going to take another year. So the challenge with a lot of these banks is not just the capital or the technology, it's the regulation, where you get the license. So we knew that this private equity firm had already bought 2 banks, one of which was in Germany. They had no idea about digital challenger banks or anything, so it was a great fit. We had this amazing technical team, clear direction, clear ideas. We had the PE guys with the money and the licenses. It was a match made in heaven. Well, what do you think? What equity do you think the private equity people demanded for 4 million euro? 80%. That makes sense because there was no traction. It was just an idea. It was just a PowerPoint presentation. There was no prototype. There were no customers. There was no mailing list. There was no website. There was nothing. So, yeah, traction is important. And knowing who you're working with is really, really important. Any other questions? How many of you are working now on a startup which is like focused on Cyprus, or Cyprus is your main market? What are you working on, if you don't mind sharing?
Because if I now 8%.
Oh, nice. Okay, good.
Started 3 years ago and we launched the website 2020.
Okay,
We followed the advice sell now.
okay.
It wasn't a perfect product, but we did it.
Yeah.
And we're glad about that.
Good.
And we're now have some traction and we're into the funding discussion.
Good, good, good. This is great because I mean, this is like one of these. See, like take Foodie, right, or take some of these other companies like this. If you're the first mover and the dominant player in the market, then there's a very good chance you can be bought out if that's your objective, and you can do an early exit, and that exit can be pretty good. On the other hand, if you want to expand, then you have the track record here, and then you can go to someplace like, I don't know, Greece. And say, look, this is what we want to do, and it's going to be a lot easier to get funding for that. But buy now, pay later is very hot right now. Anyone else? What are you working on?
For setting a platform for technologies like AI, yeah.
Okay.
Also develop our own solutions based on AI, bracket, for
Great. Great, great, great. Yeah, I reviewed that, right, for the entrepreneurship. Yeah, yeah. Good idea. Great idea. There's a lot of areas where insurance and insurtech can be transformed. Okay. Yeah, please.
So in which cases to start up into the directly, the whole person
And it's really variable, but if you let's say that you've got a small team, you have an MVP or you have a prototype, and your question now is, okay, I can spend 6 months, say, converting 20 customers in Cyprus, or I can spend 6 months and I can spend half of that time in Cyprus and then maybe half of that time converting international customers. I would really advise you to try the second route, because you're going to be a lot stronger, right? Because you'll have not just the perspective of a Cypriot customer and all of the distortions that a Cypriot customer might bring you, like delays in payment, high requirements, focus on non-standard processing. And when you then come to sit down with a financer, if you can say, look, I've got 10 Cypriot customers, but I have 10 German customers or 10 whatever, even Greek customers, that shows that you have this growth potential, which is much bigger than this niche that we find ourselves in. What sector are you in? Yes. Yeah, so for you guys, I mean, there's so many recruitment companies that I can introduce you to. By all means, and anyway, there's only like 3 serious companies in Cyprus. Maybe I'm wrong about that. But I imagine it would be easy to convert the Cypriot ones. But if you can hit some of the big names, even if it's just the country offices of the big names, you're going to be, much, much stronger. And then that, these contacts are going to network for you and introduce you to other potential customers, but also to other potential fundraisers. And this is what you can get from an ecosystem like London, basically. People are happy to recommend you when it's a good product, and they're really happy to help. So by all means, if you have if you're going to spend whatever 2 months now, say, pitching to companies, by all means pitch to the top 3 here, but for sure try to go outside, and you can probably identify these companies either through cold calling or just research. But there's also a lot of HR exhibitions that you can go to. And, in one exhibition, you're probably going to walk away with like 100 or 200 really good contacts you can follow up on later on. I think what's going to make or break, and again, I reviewed your preliminary application for the entrepreneurship competition. If you get 1 or 2 big names on board, either employers or recruiters, that's major. And the good thing is you have a service, so it's scalable. It's easily scalable. So yeah, I would definitely look outside as well, and look north. Don't go to Malta. I mean, yeah, Malta's great, Greece is great, but try to hit one of the big markets. Yeah, so there's there are 3 big recruitment firms here, or like recruitment firms that are well established. I can tell you afterward. I can introduce you to 2 of them. So sure. Anyone else? Okay. Ioana, do you want to take any questions from Zoom or?
I don't have it.
Okay, great. So thank you. Thanks for coming out on Wednesday night. Good luck with the next stage of the entrepreneurship competition. However I can help, just feel free to drop me an email. Okay?
I will reply and email, please contact the email. So that if you are too shy to ask me something today, you can ask me by email.
Yeah, if it's confidential.
Yeah, and confidential. Yes.
Okay, great. Thank you. Thank you very much. Now I will put on the mask again.
Sorry. So, Danny. Σε τι πρόγραμμα είσαι?
είναι σίγουρα αύριο, ξανά έρθει μετά από εβδομάδα Ελλάδα και μετά θα ξαναγυρίσει.
Εντάξει, ας πούμε θα είναι το επόμενο κάθε college και το επόμενο εργαστήριο για το marketing.
Το επόμενο εβδομάδα.
Ναι.
Μόνο δεν μπορώ.
Ναι, δεν πειράζει, γιατί και ο Γκάμπριελ αυτός είναι της FlexCard. Θα είναι, το ξέρεις? Θα είναι εκτός, άρα θα το κάνουμε online.
Και στις 20 που είναι
και
Σάββατο.
Και στις 20 που είναι Σάββατο είναι αυτό με το pitching που πρέπει να είστε εδώ, θα είσαι, θα τα καταφέρει.
Περίμενε, εγώ θα είμαι όλη την εβδομάδα. Δηλαδή από 15 του μήνα μέχρι και 20.
Α, ωραία. Και θα δεις και τον Μπουφάρη τότε.
Ποιον?
Τον Ανδρέα τον Μπουφάρη,
Ναι.
που είναι ο consultant για το business plans.
Α, οκ. Το έλαβα το mail, τα έλαβα αυτά.
Ναι.
Ότι μια συνάντηση την έχω κάνει με τους mentors.
Πώς σου φάνηκαν οι mentors σου?
Τον ένα τον ξέρω, γιατί είναι στο Κίο, στον...
Τον Δημήτρη. Τον Ηλιάδη, ναι. Ναι.
Ο οποίος ξέρει και λίγο πάνω κάτω τι κάνουμε και πώς δουλεύουμε, οπότε ήταν καλό. Γενικά μια χαρά ήταν.
Ο Τρυπηνιώτης είναι, εύχομαι να σε βοηθήσει. Είναι καθηγητής φυσικής. Και ο άλλος είναι